Welcome to Java. Thank you kindly for joining me. It's September 15th, 2025. It is also Monday, so I hope everyone had a wonderful weekend. I want to cover a couple of things related to job deflation. Hopefully, you had a better day than this poor gentleman who's had a little bit of deflation beneath his truck with this sinkhole that happened. So, as far as what we're looking at, let's get into what's going on in the markets. Fear greed meter still hanging in the neutral area, but a little bit more towards the greed sector. This is all on a drive toward this Wednesday, looking at not just cutting up the rates, but also the narrative. What is Jerome Powell going to say if he's going to talk about accelerated rate cuts? And I don't believe he is. So the market has pretty much priced in the rate cuts coming for this Wednesday, but they will be paying more attention. And I expect a bit more movement to happen afterwards once he goes to the podium, because we all know it's what he says moving forward. Now, 10-year yield with this is up a bit. So money is moving slightly out of bonds, nothing major at the moment, but into the stock market, looking for a better place to get yield for the money, for the dollars. So relative strength of the dollar down only slightly. It's actually up from last Friday. So not too much going on there. It's more of a holding pattern. So Friday was low volume and it's in a wait and see mode for the most part. We don't have a lot going on as far as the calendar prior to that. We'll talk about that in a moment. Cryptocurrencies have hit resistance. They're pulling back a slight bit as well, but not a lot going on really. We've got it mixed here. Future slightly up. Europe is having a good market morning so far, also pricing in because of these rate cuts, because they benefit from the US dollar being the reserve currency. So, stock market's relentless rally threatens to turn into a melt up. I wanted to bring this up because we were talking about the three phases that we are expecting. And the first is the one that we're in currently, which is pretty much a grind out and slow rise, kind of going back and forth. And the second one would be this melt up prior to the breakdown. Now, BIS, the Bank of International Settlements, is now coming out saying that the market rally is concealing deep cracks in the world economy. We've known about this for a while, and the whole reason that a lot of these rallies are happening as far as not just stocks but also precious metals are because of some of these underlying issues. Now we look at the 10-year yield, and I want to talk about that for a moment. Yields are coming down for the most part, even though this is showing slightly up right now. The market is expecting slower growth coming in. This is according to chief income strategist at Charles Schwab. So the important part of what she is saying is that the assumption behind why the Fed is going to cut rates is because the job market is deteriorating. So we're watching a breakdown. We had the massive revisions of job numbers, and there's some very key issues with this. Now, the point being, if people don't have jobs, they cannot spend. So, consumer spending, while it's still holding, they expect this to drop. And if that drops, that's where the problem comes in, because it is the engine for growth. And they're saying that they're not seeing signs of the cracking yet, but they're watching for that carefully. And this is from one of the top of Bank of America's. They're all beginning to watch this as well. Now, they're also talking about the third thing is economic growth in the second quarter. They measure it by the GDP. But the problem with the GDP coming in stronger is that a large element of the GDP, or gross domestic product, what is being produced, is actually government spend. And a lot of that is military and defense. So that's not actually producing things such as services or product sector to where it is growing an engine of an economy. These are all going towards weaponry and one time use that doesn't come back. So with this, all of this instability, looking at the calendar today, We're not getting a lot. The manufacturing survey. Tomorrow we're going to be getting some more numbers and reports coming out. But again, the big mover for this week is going to be when the FOMC meeting is at 2 o'clock. They're expecting the cut, but afterwards, 2:30, everybody will be listening to what Fed Chair Powell says. So also getting housing starts and building permits. And I believe that those are key factors that need to be watched as well. And then Thursday, more jobs numbers. So with this, speaking about jobs, I want to talk about this because it is a key factor. Now, Boeing is not just aircraft manufacturer, but they are also military defense. Now, the workers decided to reject the contract. They went on strike and they turned down through the union the contract. So, what developed out of this, we've seen a massive turning point here. Rather than going back to the table and renegotiating, the quote here from the vice president saying they're disappointed that they rejected a 5-year offer, including 45% average wage growth. They're saying now that no further talks are scheduled, and instead the company is going to move forward with plans to hire permanent replacement workers. So I hope all these people get used to these chairs or sitting in on the corner holding up signs because quite soon they're not going to have jobs at all. So, and the job market is softening as we speak. So, we've also got, I'm going to jump down here, Kroger is major grocery store. They're closing 60 nationwide and laying off another 1,000 of their employees. This is approximately 2%. So, while this doesn't seem like much, it is a massive amount. But the more important part is that it's not unique to Kroger, as this says. Many retail chains are shutting down their less profitable sites, and it's because of higher rent, rising wages, and changing shopping patterns. So, higher costs, lower income, pressuring the store networks, and that they are fitting into this wider trend. So, it's not just them, but a lot more companies. We're going to see more layoffs, more closures, and this could lead into the spiral because people that don't have work don't spend money. They're not spending money. Companies not making money, they cut back on jobs. So I want to cover a couple of things about the market. We're going to see a few specific movers. Klarna, they went public. Now, this one's in the past, but I want to bring this up because people now are saying that buy now, pay later is the only way that they can afford to buy things. So companies like Klarna, there's another one called Affirm, but people in short are going further into debt. They've charged up their cards and now they're using these companies even to finance things such as their Starbucks and their food purchases. So, major warning sign there. We've got Nvidia is down this morning, and this is because China found that they broke their antitrust laws for their country and they're launching a deeper probe. So, obviously, it's not necessarily because of that. This is a bit of retaliation and also protecting their own economy because right now they have been working on their own chips. It's a bit of competition. We've got BYD, $45 billion stock wipeout, is showing the real uh, state of China at the moment, very fragile as well. Now, on a positive note, we've got Tesla's heading up this morning, and that's because Elon Musk made a massive trade into his own stock. In short, he knows things. They've got a few things coming out. They're looking at expanding the robotaxis, and they also have a couple of other things coming out as far as their robotics. So, interesting move on that one. Now, I want to move to the other side that is kind of this dual side of stagflation, which is the worst possible scenario for an economy. Simply taking out one thing, because all of the talk about inflation, there's massive manipulation of the numbers. So I just wanted to bring this chart is the price of beef since 2019. So you can see this is a massive increase and it is not anywhere near the 2% narrative, the 3% narrative. it's quite a bit of inflation. And it's not just limited to the United States. In UK, they're talking about nearing 6%. So unless the wages are increasing at least 6% or more, that means people will be able to afford less. They're going to purchase less. We also had this just come out, Fitch hitting France with record low credit score. What does this mean? It means France is now going to be dragging down the EU again. Their loan debts are going to be very difficult for them to service. So there's turmoil ahead on that front. Now, the opposite side that's going to hold up the EU is, of course, Germany is the engine. Rheinmetall, which is their defense largest defense corporation, if you will, is also backstopped by the United States. They are now teaming up with shipbuilder because they want to create more products. So again, GDP, this is what's pumping it up, but it's being pulled from the public sector. So this is all tax subsidized corporations to keep the countries afloat. And I just want to bring that up because once this crumbles, it's all going to be 100% reliant, these corporations, upon the government, subsidies, and taxpayers. And that becomes a full corporatocracy and shifting into worse things. So we've got to be prepared for that. Now, I want to bring up a couple of other things as far as banking. Thailand. Now, I understand this is not the United States or Western world, but we're not that far from this happening. They woke up to frozen bank accounts. And what happened is they decided to implement an anti scam crackdown. But the problem with this is they did a broad freezing of accounts and they're only unlocking them as they prove them safe. So I've been advocating for not just real assets, precious metals, and cryptocurrencies, but also physical cash. This is a possibility and one reason why you want to be diversified and hold your own assets outside of institutions. Now, paired with this, moving forward, why payment firms are pushing biometrics for e commerce? Well, that depends on who you ask and the answer that you get. So, if you want the narrative that's going to be out there, it's going to be to protect from fraud, scams, and make it more legitimate for the transactions. But the reality is that they want control of all of it and they want 100% view into it for taxation purposes. So, it's just massive control. And the biometrics, of course, are going to be a problem moving forward. So, with all of this, though, a little bit of dim start tomorrow morning, but I'm wishing you a wonderful day. And until I see you again, my friends, resist.